You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show. Today, we have the pleasure of speaking with Alasdair MacLeod. Alasdair MacLeod is the head of research at Gold Money, incorporated with Shift Gold. There's been a lot of talk about recession. However, there's been multiple different viewpoints on whether we're going to have recession or not. The issue with this is that it confuses many of us average folks that are trying to make it by and trying to protect our wealth. We recently had the Federal Reserve come out and say that there won't be a recession after initially saying that there will be. We also had Bank of America come out and say that there won't be a recession after initially saying that there will be. And then we've had Fannie Mae come out and say that we will have a recession at the end of this year. So what is it, right? So today we actually get a chance to speak to Alasdair MacLeod to hopefully clear up some of this confusion on whether there will be recession or not and how to prepare ourselves for that. In the meantime, you can click the like button, click the subscribe button. I appreciate your support. Also, click the link in the description that is to the New Orleans Investment Conference that is put on by Brian Lundeen and his team every year. They've had legendary speakers there, such as Milton Friedman, Gerald Ford, Alan Greenspan. This year, they're going to have Rick Rule. They're going to have Danielle DiMartino Booth and many others. And so I will tell you more about that later on in the video. But for right now, enjoy this interview. Hello, everyone. Today, we are here with Alasdair MacLeod, who is head researcher for Gold Money and incorporating Shift Gold. Did I say that right, Alasdair?
You did.
Yes, indeed. That's good. That's good. I had to write it down, y'all. I had to write it down, but it's for a little cheat sheet, but we got it right. So Shift Gold, that's interesting because I've heard of Shift Gold, and so even Gold Money. We talked last time about the CEO being a part of, I think it was Bitfarm, and then Monet. And so now I'm hearing Shift Gold. So it sounds like y'all got your hands in a lot of things.
Well, Gold Money has owned Shift Gold for a little while now. It seems crazy that I just promote Gold Money because Shift Gold has got a good retail presence in New York and, dealing in coins, small bars, that sort of thing. So it's complementary to what we do. And I can see a great future for it because I really do think that ordinary people are so under invested, or they just don't hold what they should be holding in gold, particularly at a time of increased risk, which is in the credit markets, really. And if you want to hedge against the risk in credit markets, we're talking about everything from currencies all the way down to the banks and all the rest of it, then gold is your only way out because it is actually legal money, which not many people realize. But that is the law, is that gold is legal money because there's no counterparty risk. All the rest is credit. And I think it was the great J.P. Morgan back in, 1912, evidence to the Congress, said exactly that. He said gold is money and the rest is credit.
Yeah. I was
Nothing changed.
I was actually reading that. I was wondering like, okay, what did he say this? What was the context? So I was reading the notes from I don't know if it was he was on trial or some congressional hearing or something. And he was giving all these roundabout answers. And then he said, no, gold is money. Everything else is credit. And so that was pretty interesting.
Yeah, indeed.
So, we have a lot of confusing dynamics going on, right? And, on my channel, I try to reach the retail investor, the person that doesn't necessarily understand or have time to research a lot of these concepts. So we had the Federal Reserve, Jerome Powell came out and said that people at the Fed are not expecting a recession. This is very similar to what Ben Bernanke said in 2007. And then if you look at the NASDAQ chart from 2007 to 2008, you saw you saw it continue to go up before it took a 50% haircut. So how should we process this? Because we're getting a lot of conflicting viewpoints. I mean, obviously, the mainstream news is saying like, "Hey, there's not going to be a recession. There's going to be a soft landing." But then like the charts are saying, like the leading economic index is saying something different. So how should we be processing this? Hello, everyone. Sorry for the break in action, but please click the link in the description below. This is to the New Orleans Investment Conference. They are going to have some amazing speakers there, such as Jim Rickards, Peter Schiff, George Gammon, Rick Rule, and Danielle DiMartino Booth. This investment conference is put on every year by Brian Lundeen and his team, and they're going to have so many speakers there that can speak to what is happening in the macro environment, what is happening with precious metals, what is happening with natural resources, and many other things so that we can position ourselves to prosper. So thank you all for tuning in to this message. Now enjoy the interview.
There's so many answers to this. I think I could, probably spend 24 hours talking about this. I'll try and keep this as simple as possible. The first thing to recognize is that increases in GDP, nominal or adjusted for inflation, are not an indication of economic progress. All they show is the sum total of transactions measured in the currency of the country, in this case dollars, over a specific period of time. And if it's not annual, if that period isn't a year, then it's annualized normally. So the first thing I ask everybody to do is to not equate GDP with economic progress. By economic progress, I mean the improvement, if you like, to our general standard of living, our lives, our enjoyment, and all the rest of it. If you have a currency which is inflating, in other words, losing its purchasing power, then an increase in the nominal level of GDP is probably showing that in real terms, the economy is going backwards. So the statistics basically lie to you all the time. So that's the first thing I would like you to just bear in mind in this question. I think probably the most important point we have at the moment is that bank credit in some jurisdictions, particularly in Europe and the UK, has started to contract. Now, what this means is that you've got a contraction of credit at a time when the economy is probably slowing. Putting aside this GDP mess, which I've just described, I think it's true to say that the economy is not doing all that well. You probably find the average small to medium-sized business is finding that their costs are rising, their sales aren't keeping pace, so they need more cash. They need more credit, basically, to open the doors. So they turn around to the banks and say, we've got an overdraft facility, we want to increase it, or we want to maintain it, or whatever. And the bank says, no, I'm afraid that this is very, very difficult. Now, the reason that the banks say this is very difficult is because they leveraged up their balance sheets when times were good. And now bankers are thinking, there's a lot of risk in my lending into this economy, and I want to control that risk. I must do that, otherwise my bank will go bust. And it's a cycle of bank credit. All the bankers get optimistic at the same time, and they get pessimistic at the same time. And that's what leads to this sort of boom and bust cycle, which is a continual thing. And you can trace it all the way back in this country to just after the Napoleonic Wars. I mean, that's some history. That's about 220 years or 210 years of cyclical confirmation. Now, the reason this matters is, let's assume that you're going along to your bank and you're looking to increase your facilities. The reason the banker is going to deny you that is because he is trying to contract his credit sheet, his balance sheet. There probably comes a point where he will say, okay, what we'll do, we'll give you half of what you're asking for, but I'm afraid that the interest cost is going to be higher than it has been heretofore. So now that's the first lesson that we learn. No longer is the Fed in control of interest rates. It is actually set by the banks who are trying to de-risk their balance sheets. And so this is in effect a credit crunch. So anyone trying to sort of get some sense out of this, look at what's happening to bank credit. That gives you the clue. If it's slowed down, if it's no longer growing, then you can see there's a credit crunch on, in the making. So that's important. Now, what this means is that expectations that interest rates will merely go up, say, another 0.25% in September, and maybe that's it and done. No, this is not the case at all, because, as I say, the Fed hasn't got control over the situation. It's lost control over the situation. It is now being set by commercial banks who, remember, out of total money supply, account for over 90% of it. So this interest rate situation is important. And the first thing that it will impact on, obviously, is corporate debt. It will impact on, secondly, it would impact on government debt, not the short-term debt, because the risk-free investment for any bank is, okay, we'll run out and we buy some 3 months treasury bills. Bang, there's no risk in that at all. We know it matures in 3 months. We don't give a damn what happens to interest rates. It really doesn't matter. The one thing you don't want to do is be like a Silicon Valley bank, where you have 10-year and 15-year US Treasury debt maturities, because there you get absolutely killed on the price. And also the cash, on your P&L account, because, you were financing the position at 0%, courtesy of our wonderful Fed, and they're now saying, sorry, you've got to pay 5.25% or whatever the rate is. So you can see that long maturities kill banks. So they're going to come in, even on their government debt, and not be interested in really funding government debt at anything more than a maturity of perhaps a year or two. So this increases problems for government funding at a time when the economy undoubtedly is slowing. I mean, to say it's going into a recession, let's just be absolutely clear about this. Progress is going into reverse because the bank credit isn't there. Okay, so what happens? You're going to get rising unemployment. It may not be showing now, but it will show. You're going to get further drawdowns on government welfare programs and all the rest of it. You're going to get less taxes on the other side. So what happens? The budget deficit widens. The amount of borrowing that the government requires to cover that deficit increases. And at the same time, the cost of that borrowing is increasing. As we can see, if you look at any chart of debt interest for the US Treasury, you can see that it's sort of come up from, about 100 billion. We're now looking at $1 trillion, damn near $1 trillion. It's very, very nearly there. So the government is in a debt trap. So this is all part of this sort of situation where we're running into a credit crunch-driven crisis. I've just put inflation to one side on this. This is despite anything that might be recorded in terms of the consumer price index or whatever. So the answer to your question, I think, is quite simple. Interest rates are not going to come down. They're going to continue to be high. They could even go higher, particularly if foreigners take fright at the debt situation in the US, the problem that the government will have funding its budget deficits. Because remember, the foreigners own quite a lot of US treasuries. This rather requires the foreigners to play the game. If they don't play the game, then the funding problems are going to increase. And furthermore, it's worth noting that the total foreigner interest in US dollar financial securities, both short-term and long-term, so we're going from bank deposits all the way up to equities, is a total of about $32 trillion. Now, that's considerably in excess of US GDP, which I think is around about, 25, 26, something like that. Mm-hmm. Now, it's very important, as far as the dollar is concerned, for those foreigners to continue to hold dollars and not be net sellers in any significant way. But if you get rising interest rates, as I have just stated, if the expectations in markets are disappointed because they expect interest rates to begin to fall in 2024, if they find that's no longer the case, then we're heading for bear markets. And foreigners are not going to hang around hanging on to US treasuries, corporate debt, US equities, of which they got 14.5 trillion, by the way. And the bad news about this is that the other way, you Americans hold very, very little in the way of foreign currency. I think, according to US Treasury figures, we're looking at something like, I don't know, 680, 690 billion. That's against just even deposit money and, short-term investments, which is maturing in less than a year. That's around about 7 and a bit trillion. So 690 plays 7 odd trillion. You could also say 690 actually plays the whole 32 trillion. The reason for that is that your investments as a nation of investors in foreign equities is in ADR form. It's all ADRs. So when you sell, say, Deutsche Bank ADRs or whatever it is, there isn't a foreign exchange transaction there. It's not like there is, if you like, a requirement to purchase dollars in order to repatriate the stock back to Germany. That's not the way it works. This is the whole point about ADRs. There's no foreign exchange transaction. So you could say that Americans only has something like a bit less than $700 billion to absorb potential sales of up to 32 trillion. This is very bad odds, I can assure you. Very, very bad odds. So I'm drifting slightly from your question, but you can see how interest rates are likely to rise. They rise not so much because of the inflation story. I mean, that's part of it. And we can see that oil prices have started to rise. We've seen that Russia has now stopped letting grain go out through the ports in Odessa and so on and so forth in the Black Sea. There's pressure for prices to rise again, just from that end. But I think particularly energy prices, that is probably the problem. But there is this additional problem of the credit crunch, the fact that banks are trying to control the size of their balance sheets, which means that they're lending less. And in lending less, they make credit scarce. And when credit is scarce, the cost of it rises. That, I'm afraid, is the future that we all face, not just America, but all of us in the West.
Yeah. So what I got from that is that right now we're already at a budget deficit of about $1 trillion, and banks aren't going to be buying long-term debt such as 10 to 30 year bonds, and then as well as foreigners invested into U.S. Treasury debt or whatnot. Yeah. And so it sounds like the debt is going to continue to balloon. Because payments are going to come due. People are going to need more, not less, right? And right now, even I'm just looking at the government debt chart. We were at 20 trillion in 2017. Now we're over 32 trillion. Mm-hmm. So what happens with this amount of debt? This seems pretty extreme, like how fast it's increasing and by how much.
Yeah, I just want to correct one figure you said. That's budget deficits of $1 trillion. It's actually $1.5 trillion. It looks like even on the Office for Budget Research responsibility, rather. What is it? One of the congressional. I think the Congressional Budget Office makes a forecast, and its forecasts are $1.5 trillion plus. Going out for the next few years anyway. And that assumes, as they always assume, that there isn't going to be a recession. But, we've just sort of put this recession story to bed, I hope, a little bit. Mm-hmm. Really what we're looking at is our progress. And, if people are unemployed, we're not progressing. If businesses are going bust, we're not progressing. And that is the future, because so many of these businesses, not just government, but businesses, are over-leveraged. Look at the private equity industry. The way they've got their fabulous returns is they buy a cash cow, load it up with debt, which turns a profit margin of 8% into 40%. And they say, isn't this wonderful? Well, it's wonderful until you get the situation we're in now, where interest rates have literally shot up from close to zero up to, where are we now? 5+%. So, This is a problem, I think, which is going to be hard on the underlying economy and also on the government, because those 1.5 trillion forecasts are going to just, start going sky high. I mean, I wouldn't be surprised next year to see, forecasts of well in excess of 2 trillion again. And as to the position with the current debt, as you point out, it's risen to around about the 32 trillion level, and it's accelerating quite rapidly. And at the same time, the cost of that debt is also accelerating underneath it. Now, this is the classic debt trap. You borrow loads of money when interest rates are low and credit is freely available. And then, you go out and you spend it. Okay. And you're not getting a return on your money. You're not saying, right, I'm going to try and increase the value of this currency so that I can pay off the debt and retain the difference. No, everybody's been going out and they've been borrow. Not just consumers, producers as well. And the level of debt basically has become completely unsustainable in all elements of the economy. So rising interest rates are going to hit very, very hard. And I just find it very difficult to see any way out of this as far as the government is concerned, because they are the ultimate backstop to all this. And you've got a situation where the Fed, if you look at its balance sheet, if you marked it to market, it's underwater. I mean, it's insolvent, really. It's trading insolvently. I mean, in this country, directors in that position would be sent to jail if they continued like that. But of course, central bankers are different. But anyway, we'll gloss over that one. Yeah. But you can see that there are a number of big problems on the horizon, and it's some domino is going to topple. This is the big risk. Some domino topples, and then suddenly the whole situation just goes, upside down.
Yeah. And does this mean like a lot of we may see a lot of defaults on debt, especially like personal consumer debt? I mean, the interest rates are high. I was just talking with a guy I played basketball with the other day. He's paying $800 US a month on the car. The rents and mortgage rates are high right now, and it seems like it's getting harder on the the average middle or lower class family in the United States. And so I'm wondering if this is going to lead to like avalanche of defaults on credit if interest rates continues to rise and people can't pay the bill.
Yeah, I'm afraid it's inevitable, and you don't wish this on anyone. I mean, it's just a horrible situation. I mean, in this country, we've got a developing crisis in the mortgage market. Because the point about zero interest rates is that if you can borrow, sort of a floating rate of something like 1.5%, which is actually what mortgage rates here got down to, and you're now paying 6%, 7%. I mean, when you were borrowing at 1%, what you were doing was you were paying huge great prices for the property, because the property prices are all geared by the cost of financing it, and so we have a situation where there is a really nasty crash developing in residential property. And I mean, the various areas of property where you'll have seen this as well. I mean, it's the same is true of your residential property market, though it's less marked because of the way in which your market is structured with Fannie and Freddie and so on and so forth. But look at what's been happening with commercial property. The rents are not coming in to cover the cost of funding them. And the same, I mean, we had real problems with shopping malls for some time. But that was more due maybe to changes in the retail scene and all the rest of it. But now, if you got one of these shopping malls and you got very few tenants, and you're lumbered with the financing costs, running this damn thing. It is horrid. It really is. So it's the whole way through the economy. I think this is hitting very, very hard, Daryl. I really think it's extremely uncomfortable, bad for profligate consumers, I mean, anyone with credit card debt and all the rest of it, they rely on their jobs to pay all this stuff. And there's a frightening number of people employed who literally live paycheck to paycheck. I mean, I think in terms of employees, I saw a certificate some time ago that both America and in this country, in the UK, talking about 70% of people employed, in industries, they're living literally paycheck to paycheck. And so if a paycheck doesn't come in, that is an absolute disaster for them. So this is not good.
Yeah. So what does this mean for pension funds? So I've done quite a few videos on the pension and retirement crisis. There was recently a viral video of a man working 20 years at a company, and then something happened. The government bought them out or something, and they said that his pension wouldn't be funded. Yeah. So what does this mean for retirement and pension funding?
I think it's probably for many pension funds a growing problem, because they're not really properly funded very often, as to your point. But on top of that, you have, I think, the problem that with pensions now actually paying out a fixed amount in this country, rather than having it tied to the salary that you would be earning, like 2/3 of your salary when, on retirement sort of thing. Basically, it's the pensioner who ends up with the risk of the purchasing power of his pension going down the tubes. And this, I think, is going to hit people really very hard. I think we've moved from the golden era when you got a pension after working for 40 years or whatever, and that pension could keep you going happily in retirement. I think those days are gone. And I think to rely on pensions now is very, very risky. I really do think so. And so if people have got insufficient savings, then this is not good. It's, there's no other way to put it.
Hey, everyone, we got a break in the interview. So part 2 will be up tomorrow. Please hit the subscribe button, hit the like button. And in this part 2, Alasdair is going to explain what you can do to prepare yourself for recession or however this plays out. We also talk about the BRICS, and we talk about how the Western nations may respond to the BRICS. And so be sure to hit the subscribe button and come back tomorrow for part 2 of this interview. I want to thank you all for your support.